Welcome to the CNBC debate. In this episode, we explore how risk is being repriced across Asia and why some markets that were once deemed unbankable are now becoming investable. We are in Samarkand, Uzbekistan, the host city of the Asian Development Bank's 59th annual Board of Governors meeting. Here, we bring together a group of experts to dive into the evolving role of development finance, the growing influence of private capital, and what it will take to unlock investments at scale. Albert, I want to start with you. I want you to help us set the scene. How have the energy crunch and the supply chain disruptions from the Middle East conflict fundamentally changed emerging Asia's approach to economic growth?
I think what we're seeing really highlights some of the concentration risk that is leading many companies and many countries to think more about the need to create resilient systems as opposed to just efficient systems in terms of how they organize supply chain relationships to strategic partners who they have greater trust in. And part of that also is to deepen actually regional economic integration, to build more reliable relationships that have a foundation through trade agreements and investment agreements so that those relationships will hold up in times of stress.
So roughly 2 months into the war, what's the downside risk scenario that you have?
We just published a new study to update our forecasts for the region in terms of the effects of the Middle East conflict. The conflict in the region are likely to last further out into the future. And this has led us to downgrade our forecasts. For developing Asia, we had forecast previously that growth would be 5.1%. Now we think it's going to be closer to 4.7%.
Deputy Prime Minister, Uzbekistan is an emerging economy, and your economy has grown roughly 6% every year over the past several years. But your economy is also not immune to some of the impacts of this Iran war. So how is your government evolving its strategy and policies to safeguard economic growth?
You just rightly mentioned Uzbekistan demonstrates at average 6% growth, and this quarter we demonstrated 8.7% of growth, which I think has a lot to do with the fundamental reforms that we've been doing so far. Our strategy at 2030 is more on the institutional delivery as well. Going back to your question, how Uzbekistan safeguards the growth. We think the first, of course, the macroeconomic discipline that remains our first layer of the predictability, because we believe that for investment, growth predictability, institutionally supported and resilient to external shocks is the priority rather than looking at the growth. So we are really keen and working on the moderate public debt, substantial reserves, responsible fiscal policy, and declining inflationary pressure, which we can see on the numbers as well. Now, I think it's time for Uzbekistan to be not only the double landlocked, but better double land linked, because there is opportunity for the Central Asian countries to adapt this turbulence and to see the opportunities where we can connect and when we can link. And we see those fundamentals to be on our priority in order to keep up with the growth that we can ensure that the country remains more predictable.
Degi, as one of the leaders of one of the largest commercial banks in Mongolia, I would love to get your thoughts on the changes you're seeing in Mongolia at the country level, among your customers, and also within your bank.
So with all these global uncertainties, certainly that drives the lot of unpredictableness, and as well as it also challenges the high inflations as well. So with that regard, Central Bank of Mongolia is implementing relatively tight monetary policy. And although the inflation is coming down around like 6 to 7%, which is in the level of the what central bank targets, but still there is all these geopolitical risks and then uncertainties. There's some risk of the high inflation. So that's why the central bank is having this relatively tighter monetary policy, which is keeping the policy rate at about the 12%, and then also tightening consumer lending for tightening ratios of the debt to income ratio to the 45%. And then at the same time, the CMI level, a lot of our customers it's a bit the hold and see approach, not to invest in the bigger projects and the capital expenses. And but then on the bigger corporate levels, and then big strategic projects are still going on more rapidly as well. Because of these uncertainties, geopolitical risks, and the banks like us, for example, we're a bit cautious in the risk aversion side in terms of the underwritings, and then also we restrict some limitations for certain sectors with a very pro-cyclical one. And but then still we open for the supporting our SMEs and then the country's green and sustainable agendas as well. Yeah.
And Fahim, you sit at a very unique intersection in the private sector, but you also work deeply, engage deeply with multilateral banks, companies, as well as countries. How do you see investment mandates evolving from here on? And also, are you seeing investors willing to pay a premium for safety?
We've seen a lot of political change and shock. So in the positive piece of this is that emerging and frontier markets, which is what we're talking about and what we look at a lot, there's been a resilience, I think, built into some of these economies. And I think what the minister was saying in terms of staying the course, making the reforms, there are countries. So if you look at the rate that Albert spoke about, the average of 4.7, we have 2 countries represented here that are above that rate. And then there are others. So I think we're seeing that countries that are making the reforms, and that creates the opportunity because investors are looking for diversification and they are looking for growth at the end of the day because developed markets don't have that same long-term growth forecast. And a little bit to what Albert was saying on the macro side, where we're seeing shifts are also on trade and areas of opportunity. So there's a lot more interregional trade that's happening. Supply chains are being rejiggered. And I think that's also catching the attention of investors as well. So I think it's a slow shift, but at the same time, investors are also coming in domestically, right? As domestic capital markets are made, as local banks, as we've seen here in Mongolia, kind of increase their investment. So that is also a sign of confidence, right? When local pension funds, insurance companies invest in their own country and then invest in their region. So I think it's very interesting. It's the multipolar world is also a multipolar economy and a regional economy. From where I think we sit in Asia, there's a lot of opportunities still, but kind of staying the course on macro is what's going to keep investors confident.
Deputy Prime Minister, how do you balance moving quickly to attract global investments while ensuring that the reforms that you had mentioned earlier reach even small businesses in your country?
I wouldn't frame the speed and inclusion as as competing objectives, because the purpose of the attracting investment is not just for the investment that goes to the big companies or to the big capital. But the demographic situation in Uzbekistan, that's like 60% of the population, they are under 30. That means all the investments in Uzbekistan, they should not be just for the numbers, but it should reflect on the creating the job, access to the education, healthcare system, infrastructure, and etc. So if we look at the investment structure and what is done in Uzbekistan, we can see that a vast of the special industrial zones, they are created outside the capital, outside the centers, in a different regions of Uzbekistan. If we give some incentives in some very far regions. Like, for instance, I can do an example. In Karakkal, Pakistan, we did a lot of incentives to attract data centers and the green energy. And it actually reflects on the attractiveness of that region. All in all, I just would like to state that we are working on the local contractors, including for the foreign investment, trying to help the local companies to participate on the big investments so they can build up their credibility, their credit histories, or the capacity. So this is very much, on agenda of our president as well.
Degi, Bank has partnered with several development finance institutions where you see blended finance and de-risking structures happening at scale in your country.
So annually we raise about $500 to $700 million, and from international financial institutions, mostly supporting SME development and green and sustainable financing and gender equalities, and lately mostly supporting the digital transformations in youth and job employment, those areas. And most of those, the blended financing and joint financing, risk sharing facilities, the guarantees could work. And the most scalable is definitely the renewable energy and energy sector. That's where MDBs has a lot of interest to invest in their capital. And renewable energy plays about less than 15% of our energy supplies. But then the government's plan is to increase that to the 30% of the energy supplies as well. And these projects are now on the pipeline. Now the second areas, that's I would say agriculture areas and sustainable agriculture. Mongolia can play a very important role for that. We're about 3.5 million population, but then we have the livestock base, which is 20 times of the human, like 70 million livestock that can has a lot of potential to the export, and so that can be scalable.
100,000 every year.
Yes, 100,000 every year, and then could increase more. I think that's at least the two areas that can be the scalable.
So, Faheen, development banks want to bring in more private capital. So, I'm wondering what's top of mind for you when you assess the viability of these partnerships and projects?
I think the shareholders of all of the development banks have really been pushing for them to mobilize more, private capital into their transactions, and we've been working very actively with each of them to do that. I think there are four main ways that we do this, and we've seen this being successful. The first is a very old program, the trade finance programs that the development banks have, where they guarantee a certain participation of the trade. And I think, for example, there are countries like Sri Lanka and Egypt that have had to import wheat and fuel given all of these crises. And having the development banks provide risk participation and trade guarantees were crucial in that time. And I think that that is one way that commercial banks like ourselves have worked with the development banks. Another is that a lot of companies from the emerging markets are now looking to tap the capital markets, and we have been supporting them reach those international capital markets. The other thing that we do is we arrange co-financings. An interesting example is that we helped finance the largest pulp mill in all of Brazil, in the world, and we had IFC and IDB Invest from Latin America come into that deal alongside the Finnish Export Credit Agency, putting together a whole project that raised $4 billion for that plant. So I think it's a great partnership, and we see a very nice pipeline of transactions together with many development institutions around the world.
Albert, I'm wondering, with blended finance, risk-sharing structures, how does the ADB come in to make sure that these projects aren't just one-offs?
Right. So private sector development is now probably the top strategic priority of the Asian Development Bank. We realize that, there have been estimates of the development finance needs of the region being as much as $3.4 trillion per year, and all MDB private sector finance was about $88 billion in 2023, and that was a significant increase over the previous year. So there's activity, it's moving in the right direction, but it's very far from the necessary scale. And so really, we need to do much better in mobilizing and enabling private sector finance to support development goals. At ADB, we take a much broader view, not just specific blended finance products, but engaging governments at all levels to think about what are the constraints that are preventing the private sector from coming in to invest in that country. So that starts from even legal frameworks for foreign investment laws. And then when we get to the financing, we want to think about the smart ways of de-risking projects to attract the private sector finance. So a good example of our engagement is actually here in Uzbekistan, where one of the pillars of our country partnership strategy with Uzbekistan has been the green transition. And so we've been for many years supporting the investments in renewable energy, especially a couple of large solar energy projects were concluded last year. And as part of that, again, we have started with policy-based loans where we try to incentivize certain reforms to make the environment better. And so Uzbekistan is well on its way to meeting its goal of having a majority of its energy coming from renewable sources. And the other thing that we try to do, I mean, sometimes when you put together structured deals with the private sector, they're still kind of thinking about what are the bankable projects, and they're not always focusing on what are the most important development needs. So we have developed a facility for Pacific economies called the Wayfinder program, and that is recognizing that it's very challenging to get the private sector to make investments in Pacific economies. So we put more concessional finance because we think those development goals are really high priority. And so we use that to help structure deals that can promote development in the region.
Deputy Prime Minister, what's your key message to international investors who are weighing the risks and opportunities as they consider investing in your country? And how can you work with stakeholders in this room?
Well, my message to international investors is very simple. Uzbekistan is not only the story about the growth. Uzbekistan is the story of the reform, resilience, and of course the implementation. And I think we already has gone from the first stage of the liberalization, and we are underway on the institutionalization of the things we've been mentioning. And as a result, we attracted last year more than 40 billion US dollars to the country, which I think is the phenomenon for the region. So our long-term ambitions for 2030 is to reach GDP more than 240 billion. So that means there is a quite good opportunities for investors on the renewables, on the infrastructure, on the industry, and the trade within the region is rising. For instance, I'll just give an example of the country which everyone thinks that, you know, trade is impossible. For instance, the Afghanistan. 5 years ago, we had a trade like 150 million, but now it's more than 1.6 billion trade with them. We have regional mega projects like hydropower generation in Kyrgyzstan. We are doing together along with the Kazakhstan, or the same hydropower generation in Tajikistan. So good opportunities for the investors to have a green energy here. I think with the great ambitions that we have, it's now time for investors. The price is still low, so it's not priced in. The most important, I think, if I would say that the emerging country, or for instance, Uzbekistan has no risk, I'll be lying. So I think the most important is the predictability, visibility of that risk, managing that risk, and of course, if you can see that the risk is declining. That's, I think, the most important for the investors.
Degi, so food security and renewable energy have both come to the fore since the Iran war. Does the recent shift make Mongolia's agribusiness and also renewable energy sector more attractive to global investors?
Yeah, I think so. And most of those renewable energies and mostly supported by the power purchase agreement by the government, and very stable 25 to 30 years agreement, and quite attractive pricing. And so this kind of the commitment by the government is also making this renewable energy, the projects, and also some battery storage, these kind of projects, very interesting and also attractive. And then also there's a lot of opportunities for the energy export to the other sectors as well. That's why this ADB's commitment, like Pan-Asia, the power grid, will be definitely the interesting that the countries like us can benefit as well to export more of these energies. And then, so like Central Asia is one of the definitely the key market for us, and its growing populations and food security is important. At the same time, Mongolia is also one of the largest producer of the raw cashmere. We supplies 40% of the raw the cashmere globally, and it's a luxury fiber. And then oftentimes we export it as raw, and then not much of value adding in the country. But then with the technology advancement and the good investment into those the factories, we can add more values in the country.
Fahine, so given all of your expertise, are we close to seeing frontier markets become a fixture in institutional investors' portfolios?
So, no, I think that if I can kind of look at the past 20, 25 years of, investing in emerging markets, I think there was no such term as frontier then. It was all emerging. I think some countries have emerged in many ways, and now we have a whole category of frontier markets. And today, if you want to invest in the emerging markets, you have to be there. There is, investment on the ground. So I think in that way, emerging markets and frontier markets are definitely now much more integrated. Things are being done on the ground. There's local talent. There are connections with local banks, local, capital markets. I think another interesting theme is to do more in local currency, right? So I think that's another huge advancement for these countries. And then finally, I think, this is oft used in the past, but I think we're seeing it play out really, is how some of these emerging markets have leapfrogged, all right, in terms of technology. Being here in Uzbekistan, the internet is like blazing fast, right? So all of that opportunity exists. I think what we need to happen is that governments stay the course, not only just on the macro, but investing in the people, right? People, health, education, so that some of this leapfrogging and all of these opportunities are availed of.
Albert, help tie all of this together. Are we witnessing a fundamental shift in how frontier and emerging markets are being perceived by investors?
Sometimes frontier markets are viewed through sovereign credit ratings, which tend to be somewhat conservative. They tend to be somewhat backward-looking, not really capturing the dynamism of the current government policies going forward. And they also, for frontier markets, are often looking at indicators that are not as appropriate as maybe would be more relevant to the local markets. And so one thing, for instance, that ADB has been doing, especially for green finance projects, is to help local credit agencies improve how they do rating based on local standards and local information. So I think it's promising, and think about risk beyond the national level. I think it's really about the specific deals or the specific sectors, and to be able to assess that risk. So part of it is better data, better systems of analyzing that data using AI, et cetera. There's, I think, lots of potential here. But at the end of the day, I think investors should want to be in frontier markets, not really whether, but how, and can they build up their capacities by being available to the local knowledge, et cetera, so that they can enter these markets in a timely way as opposed to being behind the curve.
That's it for this episode of the CNBC Debate. I'm Lisa Kim. Thanks for watching.